A Heloc, or home equity line of credit, is a loan that allows homeowners to borrow against the equity in their home. Unlike a traditional home equity loan, a Heloc works more like a credit card. It provides a revolving line of credit that you can draw from as needed up to a set limit during a specified period. It's a flexible way to access cash for expenses like home improvements, medical bills, or other large costs. Here's how it works. Your equity is the difference between your home's market value and the amount you still owe on your mortgage. Lenders typically allow you to borrow up to 80 to 85% of your home's value, minus what you owe. For example, if your home is worth $300,000 and your mortgage balance is $200,000, you have $100,000 in equity. If the lender allows you to borrow 80%, your Heloc limit would be $40,000. 80% of $300,000 is $240,000, minus the $200,000 mortgage. A Heloc has two key phases. Draw period. This is usually 5 to 10 years. During this time, you can withdraw money as needed, and you're typically required to make interest-only payments on what you borrow. For example, if you have a $40,000 Heloc but only use $10,000, you pay interest only on that $10,000. Repayment period. After the draw period ends, you enter the repayment phase, usually 10 to 20 years. During this time, you can no longer borrow, and you'll need to pay back both the principal and interest in fixed monthly payments. Let's break it down with an example. Suppose you open a $50,000 Heloc and use $15,000 for a home renovation. During the draw period, your monthly payments would cover the interest on the $15,000, not the entire $50,000 limit. If the interest rate is 5%, you'd pay about $63 per month. After the draw period ends, you'd start repaying the $15,000 principal plus interest over the remaining term. One major advantage of a Heloc is its flexibility. You can borrow as much or as little as you need up to the limit without taking the entire amount up front. This makes it ideal for projects or expenses with uncertain costs, like ongoing renovations or medical treatments. Additionally, Helocs often have lower interest rates compared to credit cards or personal loans because they're secured by your home. However, there are risks. Since your home is collateral, failing to make payments could lead to foreclosure. Additionally, most Helocs have variable interest rates, which means your monthly payments could increase if rates rise. For instance, if your Heloc rate starts at 5% but rises to 7%, your interest payments would also increase. It's important to budget carefully to manage this risk. Another consideration is closing costs, which can range from 2 to 5% of the credit limit. Some lenders also charge annual fees or inactivity fees, so it's essential to understand the terms before committing. Helocs are often used for home improvements, as the interest may be tax deductible if the funds are used to improve the property. They're also useful for debt consolidation, emergencies, or funding major purchases, but they should be used responsibly to avoid financial strain.